Alright everyone, Cowboy Trades here, welcome back to the channel. So just a super quick update on the VIX and bond spreads. Don't worry too much if this chart looks absolutely ungodly, I will explain it as we do dive through. So at this moment in time, we all know about the VIX on this channel. This is the volatility index for the SP 500. This is inversely correlated to the SP 500 as you can see. And at this moment in time, the VIX is expecting a big move to the upside. However, at this moment in time in the lower time frames, we are coming back down and retesting this trend line, which is very interesting because normally yield spreads, government bonds, they follow the same direction as the VIX. And if we are looking at yield spreads, government bonds at this moment in time, you can see government bonds are absolutely pushing to the upside. Now, in terms of all of these different charts, you don't really need to worry too much about what the individual ones are. You can see the key to the left side of the screen. We're looking at, the US 2-year yield, 10-year yield for the US, Euro 2-year yields, Euro 10-year yields, Great British 2-year yields, Great British 10-year yields, also D02 or D2-year, which is the German 2-year bonds, and IT02 and IT10Y, which is the Italian 2 and 10-year bonds. I don't know why I didn't... the German government bonds, the 10-year yield, are these green and red candlesticks down here. I had to have a base chart to put this on. So why is this important and why am I telling you at this moment in time that the yield spread is going up while the VIX is going down? Well, these do not diverge for too long. And if government bonds keep on pushing to the upside, which they 100% will if financial conditions continue to tighten, this is going to drag the rest of the markets down. Now, like I said, this chart can be a little bit daunting if you don't understand the fundamentals of government bonds. You don't really need to understand the fundamentals to see the correlation. Government bond profitability goes to the upside, and this is bearish for the S&P 500. In fact, you can see government bonds more or less just stagnated at really cheap levels during this entire bull run for the S&P 500. And when did the S&P 500 really start topping out? Well, it's when a lot of these government bonds, like the US 2-year and the 10-year specifically, you can see this blue line was the leading indicator, that is your US 10-year. Once US bonds started increasing in profitability, government debt profitability started going up, the demand for government debt started increasing, and we know this because government bonds were increasing, government bond sales were going through the roof. So with the increase, this massive run up in the yield spread, we of course saw the S&P 500 start to break to the downside, and we can see a very strong correlation in this market. For example, you can see over here the exact top for basically all of these yields. I was about to say, the Italian ones, but it's also the Euro, the 10 years, the Great British, D2 years, D10 years, which is the German bonds. As soon as these bonds started to decrease in profitability, you can see how the S&P 500 snapped up to the upside for a mini rally. And if we remove this, very quickly you can see, where did this peak in the S&P 500 correlate to? Well, it didn't correlate to the exact bottom for government bonds, but once government bonds started to rush up to the upside once again, it meant the S&P 500 was ready to start moving to the downside. So it's very interesting right now that we're seeing government bonds absolutely explode. I'll show you some of the most important ones in a second, the US 10 and the US 10-2. It's very interesting to see government bonds and the yield spread is rushing to the upside, and the yield spread normally follows in what the VIX does. So these normally walk hand in hand together most of the time. It's very rare to see a decorrelation or a derail from the VIX and the yield spread. So right now the VIX is coming down to a very important trend line. You can also see this kind of box over here that I've highlighted. We've been rejected from this. We've been rejected. We tried to poke our head above it, rejected, poked our head above it, failed move equals a fast move. You've got wicks down here as support, wicks as support, wicks as support, candle body closes as support rather. This box that we're coming down to is a very important range. Excuse my voice, I've got a little bit of a cold right now if you couldn't already tell. But as you can see, the VIX should really start pricing in this increase in the government bond profitability very soon. And the S&P 500 is already pricing in the increase in government debt profitability, like we've been talking on this channel for quite some time. We've been letting you know, the markets are getting ready to nuke. And of course, with government bonds rushing to the upside, this is really the nail in the coffin. We've already had bad economic data. The S&P 500's topped out. Liquidity conditions have topped out. We've talked about all these things on the channel in the past couple of days, in the past week or two. And also to wrap up the video, just a quick one for today, but the US government bonds, the 10-year yield, one of the most important ones, is currently breaking out of this bull flag at this moment in time, or bullish pennant, whatever you really want to call it. What's interesting is the US 2 years hasn't quite broken out. So the 10 is outperforming the 2. In the higher time frames, if we do look at the US 10-2, you can still see this is making lower lows and lower highs. If you don't understand what the US 10-2 is, I have made an educational series update on this down here, understanding market conditions, where if you don't really understand too much about government bonds and their impact on the market and you want to learn more, then you can come and check out this video. But if you just want, the technicals and you're not too interested in learning about the fundamentals, all you really need to know is when the 10-2 goes to the downside, it is a sign that the 2-year is outperforming the 10-year, and that is normally a sign that financial conditions will continue tightening for quite some time. So I've got my eyes on the US 10-2. This still looks very bearish in the lower time frames, but even though it is popping its head up a little bit, this is really because the 10-year has broken out, which of course, with the 10-year and the 2-year looking like it wants to break to the upside very, very soon, it's looking like government bonds are going to take a huge run to the upside. And why this is particularly important for the US 10-year and the US 2-year, not in particular, the Italian, Great British, Euro bonds, German bonds, etc. Why this is really important for the 10 and the 2-year US bonds to be breaking out at this moment in time is the fact that governments, or specifically the US government, they can't print any more government bonds, because what are government bonds? They're basically government debt. If you're buying up government bonds on a 10-year basis, on a 2-year basis, you're buying government debt. And what happens when the government debt what happens when the US national debt ceiling gets reached, which it currently is? We talked about this in one of our most recent videos, but the US debt ceiling for this year has finally been hit. So the US can't print any more government bonds, meaning they can't sell any more government debt than they already have. So basic economics, supply and demand. What happens when there's less supply in the market? Price goes up as long as everything else stays constant. So the US, they can't print any more US 2-years, they can't print any more US 10-years until at least next year, which they're already talking about doing in Q1, of course. But for the rest of this year, we've talked about this on the channel, liquidity conditions are topping out. We've had another traumatizing event in terms of economic conditions, and of course, economic data rather. Like I said, I'm a bit under the weather right now, so please do bear with me. But as you can see, once again, the supply is going to be diminished from the US 10-year and the US 2-year while the debt ceiling has reached its limit. And with this, if the US bonds continue to move to the upside, the 2 and the 10-year continue breaking out to the upside, the rest of the yield spreads, the rest of the government bonds will continue running to the upside. And as we talked about, why do we care about this? Because, in reality, talking about government bonds, talking about bonds in general is very, very boring. I do understand, but we look at these because they are market leaders, and while it's not as fun as coming over to Bitcoin or going over to the SP 500 and doing TA, these are leading market indicators, and if you understand how these work, you will become a better trader and better be able to understand when market conditions are ready to pivot, and subsequently when the stock market will bottom and when cryptocurrencies will bottom. And government bonds pushing up is a big, big sign that the S&P 500 has further to break down to the downside. So all I've got for you today, very strange divergence going on with the VIX and the government bonds and the yield spread. Nonetheless, I do expect, as the debt ceiling has been reached, the profitability of US bonds in particular will continue increasing while financial conditions continue to tighten. And with the rest of these bonds continuing to push up to the upside, the VIX will soon follow. And of course, like we talked about, S&P 500 is inversely correlated to government bonds in the VIX. As you can see, the S&P 500 had a massive rush to the downside. Why did it do this? Because the options expirations on the volatility index for the S&P 500 started pricing this in. These are inversely correlated, and once again, if government bonds continue to push up, the VIX will continue to push up, and the S&P 500 will break down. And of course, if the S&P 500 breaks down, your crypto markets will break down. Like I said, I know these are a little bit daunting. I know these are a little bit boring in comparison to looking at cryptocurrency videos, but these are absolutely market indicators. And while these videos aren't as easily digested and as well watched as, my Solana videos, KDA videos, Bitcoin videos, I'd much rather make, content that doesn't have as much views in terms of the stock market for the smart money me who really do appreciate and understand how the equity markets, bond markets, financial conditions all affect the greater markets in play. So all I've got for you for today, my friends. As always, my friends, if you do enjoy the content, let me know down below by leaving a like and a comment, share the videos with your friends, and if you haven't already, be sure to head over to my Discord and my Twitter. If you come over to my profile and click about, you can see all of my official links: Twitter, Discord, Instagram, and my merch store is all linked down below. Anyway, it's been your boy Cowboy Trades. I'm out. Peace.